Good morning, ladies and gentlemen. Well, back from holiday, and it's always the case when you go on holiday, the market goes berserk. What is happening here? And what I'm trying to do is I'm trying to marry together the what the yield curve is saying and what the equities are saying, and I'm finding it very hard to do so. All I know is that the yield curve in 40 years has never betrayed me, and equities betray me every day. So I trust the yield curve more than I trust the equity market, and I will try to explain to you today what I'm looking at in the yield curve and what I'm waiting for it to tell me, and then I can position in equities. Before that, I will not sell equities. I have not sold equities all quarter, and I see no reason to sell them until the yield curve tells me it's time. The most important part of the yield curve, of course, is the 2s30s and the 5s30s. Now, if you remember, this is the area in the 2s30s and 5s30s where the stock market was trading at 39.50, and where I basically said selling equities here before the close is dangerous because either we close below this line or we close above it, in which case equities will rally, and there's absolutely no point in doing anything now, but let's wait and see what the close is. So that was at 39.50, and what happened afterwards? Well, we just went north in the yield curve and equities rallied, what is it now, over 200 points. This is saying that the yield curve is not disinverting now. And let me explain to you how I view a disinversion of the yield curve. First of all, an inversion of the yield curve means that financial conditions are getting tight and increasingly tighter, and that eventually should lead you to a recession, whether it's mild or deep, whatever, it eventually leads to a recession. A disinversion of the yield curve should give you the timing of that recession, i.e., it should tell you when the curve disinverts and goes back towards these levels which are positive below. It should tell you that the timing of that recession is now, or it should be very, very close to the timing of a recession. As you can see, it bounced exactly from the zero level and just jumped back up. That tells me that the market is not yet ready to call a recession, and that is, I guess, why equities rallied, because if there is no recession, why should equities go down when earnings are not horrible? The valuations might be high in equities, but we are not going to get a recession. We could get an acceleration in earnings, and that is what the yield curve is saying. Same thing, exactly the same thing in 5s30s. Here you have that level below 29, and basically what we're now waiting for is a close below there, taking out this whole area of trading for the best part of 2 years, and that will tell us that recession is here. Until that happens, until we close below these levels, there is, to me, no chance that equities are going to be weak for anything than, I know, small normal retracements of 2, 3, 4%. Below here, you are starting to call for recession. But I think it's going to take a while before that happens, and we will trade then up to something like par here in the 530s and then maybe even up to 11, but that seems to be as far as we can go in terms of that curve. But I'm trying to give you an overall view of where I see the real danger. The real danger comes below these levels where we traded at, you know, this level. If we close a week at this level down here, I'm buying all the puts in the world in SBX because I think the timing, the bond market is telling you that the timing is now. At the end of a quarter, it's always helpful to have a look at quarterly charts of the individual tenures and see what they're doing. You can see how important this 369 level is in twos. This is a quarterly chart of twos, and you can see how many times it's bounced right at that 369 area. We closed at 402, which is just about a quarterly outside quarter. So what can we say about this? I think that we're more likely to see this than not. The Fed is basically as clueless as we are. They are completely data dependent, and they have a non-farm payroll next week and then a CPI after that to basically make up their mind as to what they're going to do at the FOMC on the 2nd and 3rd of May. Is the non-farm payroll likely to be a shocker, i.e. either much weaker than expected or much stronger than expected? I think it's unlikely, simply because none of the weekly numbers for unemployment that we get or have got have indicated anything out of the normal. I think the Fed, just like us, is afraid that this mini banking crisis is going to significantly tighten lending standards and diminish the amount of lending that the banks are willing to do. Yes, we can be afraid of that, but we see no data on it at the moment confirming or denying. That's why these numbers over the course of this month are going to be so important, because they are going to finally reflect what the real effect of this banking crisis has been on the economy. Personally, I suspect it's going to be very muted. But, my suspicions are not hard data, and therefore I will just ignore them and look at the data and look at how the market reacts to it, knowing that this 470 level in twos is absolutely critical. If we change that back to a daily chart, we can basically see how many times we've tried to trade below there and always rejected it. Now, are we likely to be above 426 on Friday before the NFP? I doubt it. I think we're going to remain in this range. The market certainly needed some duration for quarter end, and there was quite a bit of buying. So I think that we spend a relatively quiet 4 days trading between, let's call it 390 and 420 or 422, and then we see. I think non-farm payroll is going to be absolutely crucial, because what you are having at the moment is a complete dichotomy of what the bond market is telling you and what the equity market is telling you. The bond market is definitely worried that something is happening. The equity market is not worried in the slightest. And the yield curve will resolve, as I indicated earlier, by flipping to positive indicating recession or not flipping to positive. So really, all the action is going to be in the shorter end, while the longer end remains more stable. So now we'll look to the twos. Let's look at the fives. You know, they're trading technically very well. We know what the big level is here, 328, and we also know what the resistance is here around the 370 area, and it caught it beautifully on Friday. I said, you know, be longer futures and then flip around here. This is where we flip because I think it's much more likely that the market will then be in a range until Friday. And my suspicion is that if Friday the numbers are good, i.e. non-farm payroll is as expected or even stronger than expected, i.e. less unemployed people, then we're likely to get a move back up to this 382 area, at the very least in fives. And if we look at the tens, I think much the same thing. I think we're likely to trade these levels early in the week around the 389, 339, something like that, and then we bounce. And after the figures, if they are, as I expect, stronger than expected, you will see this area around the 370. And much the same in the 30s. I think the likelihood of seeing the 30s below 360 below Friday is not great. And after it, if the numbers are bad, the likelihood is that you might see them above 377 quite easily, or at 377. I certainly suspect that the volatility in the long end is going to be by far the lowest. It's all about the right pricing about the, at the short end, because at the moment you have a very anomalous pricing where you have the short end indicating the distinct possibility that we go into a recession and that the Fed has to cut rates. And I don't think, what I think is almost impossible is that the Fed holds rates with nothing happening for 6 months. I think that that is the least probable event or outcome rather. The likelihood of the market of something not breaking when Fed funds are at 5% or higher and the yield curve is 100 basis points inverted between overnight and 30 years, even 130, 150 points inverted, is very unlikely. Because if you look at how long an inversion lasts, and let's go here to a monthly chart of 230s and go back in time, how often have we remained at these extremes? Well, this is the highest, and this was in 2000, and it was basically 1, 2, 3, 4 months. Something is going to break, and when it breaks, it's a cascade which happens in the course of 6 months as well. You know, for this to happen in the course of 7, 8 months, you know, it takes you back to rates which are very close to zero, or let's call it 1%. At the short end. So you can see how all the volatility is going to be at the short end relative to the long end. I don't know what's going to happen. I have about as much clue as anyone else, and anyone who actually tells you that they know is completely full of shit. All I know is that when you have so many months trading at negative, you have 1, 2, 3, 4, 5, 6, 7, 8, 9 already, and here you only had 4. The likelihood of fast moves back down exponentially increases. We have our levels, we know what they are. We are going to patiently wait for the market to tell us when the timing is. And that is all we can do at the moment, because the narrative that all these different asset classes are giving us is completely different, and therefore we just don't know who to trust or what to trust. I trust the yield curve. I trust the timing that it gives me, because it's never really lied to me. The best example I can give you is here in 2006 and 2007, when I was screaming that a recession was coming, and I just didn't get the signal to sell S&Ps. I got the signal to sell S&Ps here in July, August of 2007, and you all know what happened after that. Trust the yield curve, believe me. Let's have a look at some long-term charts in Germany. This is a quarterly chart of the Schatz, the twos. Almost perfect really, and closed unchanged. So all the volatility of the quarter gone, closed within a few basis points of where it opened. It's still outside the quarterly Bollinger Bands, but we'll ignore that. If we go to monthly charts, it's probably going to be clearer. 268 basically is its level for the time being, trying to decide if the ECB is going to be actually more hawkish than the Fed. And the odds are that it will for a while. So I would have thought that we've seen the bottom of Schatz, and that it's likely to go slowly back up to this 340 level. But that's just my bias. I think that we are probably likely to do one of these over the course of many months, which probably tells me that there's not a lot to do in Schatz for the time being, and that we are better off trading the US than Germany after many months. If we have a look at what the fives are doing on a monthly basis, they are better. But on a quarterly basis, they are just about unchanged as well. But it's normal that the back of the yield curve should do better than the absolute front end. I think the fives and the tens in Germany are probably topping out at these levels. Very likely that we have probably seen the highs in Germany at 285 in the bubble, and around this same level in the bunds. I tend to think that we are probably at some crossroad, and if I see 257 again, I'm sorry, I think the likelihood is that the bunds are a buy. It's just that I can't see the differentials going much worse than they are at the moment, and the differentials are in here. This is the really important one. I think 105 is going to be as far as we go in this differential. I think here, buying around 105, buying bunds and selling treasuries is probably the smart trade. I mean, I caught most of this move down, so I'm happy about that. But here I think I start fighting it, and we're only 13 basis points away. Around 105, I think the bunds are the better buy than treasuries. What does that indicate to me? That indicates to me a period of stability at the very least in the bunds, while probably the tens, as I showed you earlier, start going higher in yield. And then from these levels, we probably can go back up towards 125 and then 135 and possibly even 152. So at these levels, I think the risk reward is very much to be long of bunds. I also want to draw your attention to the German yield curve. This is 230s, and as you can see, it's never been this inverted. I think this 192, 193 level is going to be very important, and this is a weekly chart. I'm setting a reminder here. I think even if over the course of the next 2-3 weeks we can't close back above there, that is some sort of a signal. And I think that then the yield curve in Germany can disinvert, get less inverted very quickly to about this kind of level, 40. That is a big move, and it'll happen quite quickly. I don't know how that is going to affect the US, but it basically is saying that at some stage over the course of the next several months, we will see a rapid disinversion of the yield curve. How that is possible at the moment with the ECB while the ECB keeps on saying that they are going to tighten, I don't know, but it is something that is puzzling me. I'm questioning it, but if over the course of several weeks we don't close above 192, I think the trend has turned, and then I think the likelihood is that we do some options looking for this market to trade back down towards 40 of inversion at the very least. And that's a big move. That's 150 basis points. If the German curve were to disinvert by 150 basis points between 2s and 30s, I find it very difficult to believe that you wouldn't see at least half of that move in the US. And half of that move is 70 basis points, and that basically gives you a flip in the yield curve in the US, and that basically gives you a warning of recession. How it's going to happen, why it's going to happen, I don't know. We will look at the data. We know the level, and I think it's going to be very, very important to watch this over the course of the next few weeks. Just like the bond market is now caught in a range at the lower levels before NFP and before the yield curve decides what it's going to do, the dollar seemed to be caught in the same dilemma. It's basically now, it never got to the level that I wanted to sell, 106.25, and it's not quite at the level where I think the risk reward is to buy it, which is between this 139 and 99.80. So let's call it 100 between friends. That's the kind of level that the risk reward says it's done enough. And really, I think that it will move together with the bonds after NFP. Because if NFP is still strong, I think the short end of the US will basically start giving up. Twos will start going higher in yield. All the SOFR contracts in 23 will start going higher in yield. The yield curve will flatten again, i.e. go more negative. And I think that will boost the dollar towards this 105 level. So I guess it's caught in the same, basically in the same dilemma as the bond market and the Fed, because the Fed is caught in the same dilemma and looking for data. Not much more to be said. If you look at the Euro USD for those levels, well, those are up here. looking at 110.60 as a very good risk reward level to buy puts, and you're looking at this area between 105.20 and 104.61 as a very good level to buy calls. That's all I can say at the moment until I've seen NFP. And NFP will tell you a lot because, it's one of the main data points that the Fed is going to look at before they make their decision on the 3rd of May. After that, of the really, really important data, we have CPI. And we also will start getting a whole load of data about the real economy, like retail sales and stuff like that, which they will look particularly carefully at this month because of the possibility, as I said earlier, that the banking crisis or scare or whatever you like to call it is affecting consumer behavior. I think that likelihood is not great. I don't think it will have affected them that much, but the data will speak very clearly. And so will the yield curve, and the dollar will react to it. I would have thought that there will be a lot of stops above here, so we might get better levels. If the economy turns out to be weakening, they will really pummel the dollar. I don't think that is likely. I think it's much more likely that they stop everyone out and then reverse back down towards this 106 area. I don't trust dollar weakness at all at these levels, not until I know what's happening to the economy. And to my mind, the US economy has always been much more resilient to any kind of a shock than the European one. Gold is, trading technically extremely well. It's at the top of the weekly Bollinger Band, but that's not surprising given what the bonds have done and what the dollar has done. What it's not indicating to me is that it has a huge amount of impulsion at the moment. I think 2045, you definitely let them have some. I think the big danger in gold, just like in bonds as I showed you earlier, is that the numbers are strong and that the bond market gives up most of the gains that it's made in the course of the past couple of weeks, simply because they start looking for the Fed to tighten again and for real rates to go more positive. So I think the danger for gold is that it breaks 1859, and you can see how well that 1859 support has held. I think it's much more likely that we go through 1859 and trade down towards these kinds of bottoms just around 1900, or you could actually call that 1881, which is the very important line, and come down and fill this gap. I don't trust gold at all at these levels. I think it's far more likely to be a sell than a buy, around this 2000 level. I would much rather see it at 1881 to give it another go. And that matches my view in bonds, and that the data in NFP will show an economy which is not slowing, which gives you a stronger dollar, which gives you higher rates, and especially at the short end, and that gives you a lower price of gold. DBC really isn't doing very much, but it's not strong. This is not a strong formation. It keeps, although it closed above, at the highs of the week, it's really where it's been for the past 2-3 months. This to me is not the sign of a market which is waiting to break to the upside anytime soon. And especially if you look at gold DBC, gold has reached a high. Well, let's enlarge that. You remember at these levels I was saying I prefer gold to DBC. Well, here I probably prefer DBC to gold. Um, which doesn't mean that DBC goes down. It probably means just that gold is, goes back down towards that 1881 level. A bit of time, it goes back down towards 7, which is 10%. Um, and then we are ready to start motoring again on the upside. So what these charts are telling me is that DBC is going to remain a nothing market because oil remains a nothing market. This is a monthly chart of oil, and you can see lower highs closing lower. Um, this is just not hugely bullish. I think around the 62 level, if we see it over the course of the next couple of months, it's a good risk reward to the upside. But, in the meantime, you have a 200-day moving average going down on the dailies. All it does is goes to the moving averages, fails, comes back down, makes a new low. And this is the behavior that we saw in October, we saw it in December, we saw it in January and February. It's just not an impulsive market at the moment. New lows are going to be more likely than not, but around this 62.50 area is where you really would like to buy some longer term calls for oil, and it's more likely to go up than not. It's interesting to look at quarterly charts of the SPX sectors, which basically tells you which sectors are pulling the indices up. And as you can see, it's XLY and XLK. All the other sectors are more or less unchanged. Very small gains, very small losses. XLI is up a little bit. XLU is down a little bit. XLB is up a little bit. It's XLP is up tiny. XLV is down. It's basically XLK and XLY, but XLY is 50% Tesla and Amazon, and therefore you can treat these two imposters much the same. So here we have XLK. It's a very impressive performance. Basically, it's gone from 123 to 151, which is a hell of a lot. And that basically tells us that we have to look at NASDAQ much more closely than we have to look at SPX to find out what is going on and where the resistances there are and what we're likely to do. So this quarter we'll pay very, very close attention to the NASDAQ and to the turning points, but that would make sense because the NASDAQ is longer duration, tends to be, and therefore you have a higher susceptibility to what the bonds and the yield curve might do. So what these sector charts are telling me is to pay particular attention to the XLK, XLY, which are the same kind of imposter. I think these other sectors are going to be much less susceptible to what the bonds do, and these are going to be very susceptible to what the bonds do. Again, this is going back to pay attention what the yield curve says, and when it breaks, don't fight it. Until then, you can fight it all you like, but when the yield curve breaks, no. So here we have a monthly chart of the NASDAQ, and it closed on Friday on that last little squeeze above this very important 13,004. I think the odds are that in the course of the month it touches the 13,840 level, and that to me is going to be absolutely crucial, because if we start closing above there, I see very little likelihood that we don't trade at least in the 15,000s. And these are big moves, and that would imply to me that the yield curve is not going to give us any good signals. But in the meantime, if we have a look at a much shorter time frame, the 195 minutes, so that's 2 bars per day, what do we see? We see some gaps around here, and then we see a big gap up there. So I would have thought that the natural resistance over the course of this week is going to be 13,717. That is the level where you really think that the risk reward of being long is not good. Okay, just absolutely appalling risk reward. If we see that before Friday, I'd be surprised. But if we see it and you're long at 13,717 or not hedged, that is appalling risk reward. At that level, buying some puts, put spreads, whatever you like, almost a no-brainer. However, longer term, what this shows you is that we've turned the moving averages, that we are very, very unlikely to come back down below 12,000 anytime soon, which says that the market over the course of the next week is not going to be weak, or any weakness is going to be limited to the normal 2-3%. And I don't need to tell you that that is actually what volatility is saying, because look at the VIX. I mean, the VIX is down at 1870, and it's basically saying that any kind of a spike is going to be really limited. And throughout this episode, the VIX has remained negative in terms of the moving averages, and we never even attempted to close above 30, which is my trigger. That all tells me that we are in a low volatility environment for equities still. And that actually marries with what we saw in the yield curve earlier, when the 230s and the 530s failed at that level. What was it? A couple of Fridays ago. And basically the market never looked back and just rallied. So if we look at what ES is doing, and we have look at a weekly, well, I would have thought that 41.64 sorry, this is INX, 41.64 next week is a complete given to me. And then after that, we have the very, very important monthly levels, and these are the monthly levels, 41.81, the equivalent of which the Nasdaq has already breached. Let's try to enlarge this. To me, this 41.81 level is extremely important. A monthly close above there, and I think we are at 4,400 in no time. And possibly even at this kind of level, 45.23. So what I'm saying, but on the other hand, look at how undecided these moving averages are now, because you could get a monthly move of 41.81, which absolutely negates this whole thing. And that is again tying in what will the yield curve do. To me, this month, what the yield curve does is going to be absolutely key. Because otherwise, if the yield curve does not start disinverting, you will get these markets going even higher. And I would bet that 43.95 does trade. The yield curve has done us, proud throughout this episode. It stopped us selling. It'll either stop us selling or not. But I think this area here is likely to trade between 41.64 and 42.47 at some stage over the course of the next couple of weeks, which to me indicates, again, when you put it all together, what it's saying is that the economy is still fine. The data is going to be strong-ish. the Fed is still going to have to hike, the yield curve is still going to invert more, and that we are not yet at the disinversion phase. That's what putting it all together says to me, and I can't see how what equities are doing and what the bond market, especially the short end of the money market, is saying is just incompatible. Either we get more rate hikes from the Fed, or equities are far too high. And I think it will resolve itself by the equities being right here rather than the money market short-term rates, and that the yield curve keeps on not giving disinversion signals. To me, not giving disinversion signals is a green light for equities to do better over time. I wanted to show you my clean chart as well, with all my clean important levels. I think there's very little doubt that over the course of the week we trade 41.66. Don't forget this is INX, it's not ES. Add whatever the basis is, 25-ish. So you're looking for ES to trade 41.90-ish, something like that. Very little likelihood that we turn before that kind of a level. You can see the levels here and here, and then we can have, you know, a 80, 90, 100 tick reaction and maybe come and fill some of these gaps. Who knows? But to me, equities are bullish, and I can't reconcile that with anything but strong numbers from the economy and maybe a fear from the Fed to hike and therefore let the economy run hot for a while, which the bonds don't like, the long end of the bonds don't like. But we will be followed, we will follow what the yield curve says to us. If there is no disinversion, if those levels hold, it's still a green light for equities, or it's basically not a sell for equities. And I'm just not going to sell equities whatever level they're at, unless the yield curve tells me that the timing has arrived. Neither the yield curve is telling me the timing has arrived, nor these patterns are telling me that we are anywhere close to exhaustion of these moves that we are getting at the moment higher in the equities. If we look at the foreign markets, look how close we are to the highs for the past quarter, a couple of quarters in the DAX, and how close we are to the old-time highs, which are right here at 16,500. We are 800 points away, which is basically 1 week's worth of price action. All this indicates to me that the likelihood that the short end of the bond curves can do much better at the moment is limited, because, you know, are we getting recession? No. Will the Fed cut unless it sees very bad data? No. Is very bad data on the economy, can it basically live together with these valuations of equities? No. And therefore that tells me that, you know, the equity market is probably right. The economy is just fine. We're not going to find out that the real economy has really suffered at all as a result of the banking crisis, and therefore we will likely find out that the Fed needs to tighten more, which keeps the yield curve in the range that we've seen for an extra few months, and then probably the yield curve can tell us something when everyone least expects it, and everyone is actually bullish and everyone's buying because the DAX is above all-time highs. That will be the time to worry. Probably the time to worry is not now. And certainly that is what the Nikkei is saying. Nikkei is about to bust out of this huge range that it's had for such a long time, basically with the top being at 28,335. If it goes through 28,335, it goes to 29,435 quite quickly and takes out these guys here. So basically all the equity charts agree that the economy is, has got lots of liquidity. It's not bad. Earnings aren't going to be bad. The market can do better. It's basically as simple as that. And as long as that lasts, you are very unlikely to get much better, how shall I put it? You are less likely to get a yield curve which tells you that disinversion is happening because the short end is doing better than the long end. It's just very unlikely. And here we have all the levels that I've changed. The yield curve will be watching, but as I told you, I think the likelihood that it's going to show us that kind of disinversion is extremely low. It's not going to happen for a while. We know what the levels are. As I showed you in the bond presentation, we know exactly where the 2s30s and the 5s30s show us that a collapse of the economy is happening. Until that happens, there's absolutely no point in even thinking about playing it to the downside. The likelihood is that it reverts back upwards, i.e. it flattens more, simply because the short ends are going to have to give up because of the negative carry. They're going to have to keep on giving up. Every time a piece of strong data comes in, they will have to give up and give up and give up and go back towards Fed funds. If that happens, I think there's very little likelihood that gold can do higher than 2045, and buying put spreads at that level is, I think, a great thing, looking back towards 1881. And just like I think that the likelihood of the bonds breaking these levels before NFP, and unless NFP is a real surprise, we will be heading up towards resistance. Thank you very much indeed, and tweet you on Monday.